Hello. Happy New Year, everybody. Welcome back to Hurdle Rate. I hope you've had a great start to 2026. The first company that we're going to analyze for this year is going to be Shake Shack. And as you can see, over the last few years, the price has ranged quite a bit. We've had a low of 40 down here and peaks of nearly 140. The price is currently at about $83.5. So yeah, let's dive straight into it and see what the intrinsic value of this company is. So open up your spreadsheet. As always, let's remove the grid lines. Go view, breathe your first column. In front of your A, insert another one. Make your A smaller and your B larger. And we're going to go SHAK, which is the ticker. I think the Microsoft Excel server seems to be down at the moment because it's not letting me select the stock, but we can just do that manually for now. And in another video, we'll do it so that it's linked dynamically for the pricing. So the first line we put here is ticker, date. I'm going to zoom in a bit because it makes it easier for you to see. And we want the current, the current price, the implied price, and any up or downside for the company. Let's do a bit of formatting. Not that one. We want this one. Border. Use the dotted border. This first line is going to be our assumption. Put an X in the A column where where we're starting the section. And this is just so that we know that a new section is starting. So the first thing we're going to look at are the assumptions. Ticker SHAK, the date 04/01/2026. The current price we'll have to, again, we'll do it manually, 83.47. And these two we can leave for now. So assumptions, revenue segment, and we want a bare base full. And these will make sense as we're going along. Instead, actually, the way we're going to do this is going to be slightly different than normal. We're going to look at the average unit costs for the average unit costs for Shake Shack for each restaurant, and then that's how we're going to derive our revenue. I forgot to say, come onto the SEC, search for Shake Shack, open up the latest 10Q, which is here, which is a quarterly report, and open up the most recent 10K, which is the annual report. These are all on the first page. They're the first one is maybe a quarter of the way down. The 10K is about halfway down. So onto this is the 10K. Come to page 47. We want to see how many restaurants, company-operated restaurants, the company has. And then on the 10Q, come to page 27. So let's first just go to, okay, this is what we want. SHAK sales. I prefer it on the income statement. Yeah, so we get all of the years. So we want SHAK sales. Then down here, licensing revenue. But instead of us forecasting just by putting a growth rate onto here, we're going to look at the number of company-owned stores. Then we're going to look at the average revenue per store. And I'll show you how we do this in the revenue build. We're going to do something similar for the licensing revenue, which these are their franchisees, and most of these are international. There's about maybe 40 franchises in the US, but the majority of this is for the average revenue. Yeah. We just want to put a 2 in here. Leave that for now. Then we want EBIT, WACC, and terminal growth value. Your EBIT is your operating income, your WACC is your weighted average cost of capital, and the TGV is your terminal growth value. We'll cross that bridge when we come to it about these two, but for now we don't need to worry. So yeah, let's again copy these. Okay, revenue build. I haven't thought how to lay this out yet, so we'll do it as we. Okay, so we're going to go equals E10. The switches are going to be on these two. That way we can simulate with the number of stores growing and the revenue increasing per store. Because SHAK currently has about 370 company-operated stores and maybe another 250, 260 internationally that are franchises. So we're going to model that growth. They eventually want to get to something like 1,500 company-operated stores, of which will be predominantly in the US. And they're growing at about, I think, maybe 50, 60 stores per year. I think maybe a little bit less, 45 to 50. So, but yeah, we'll get to that in a second. Then we want, what do we want? Bare, base, bull. Bulls B16. Sorry, no, B12. For me, it's B12. I won't bold those, but we keep them bold down here. Okay, so for sales, so SHAK reports in thousands rather than millions, but we're going to do this model in millions. So it will be 869.270 rather than 869.270. 69270 1046.819 1207.561. Now let's go up to the number of stores. Okay, so in 2024, they had 329. Company-operated stores. I've already opened up the previous 10Ks from 2023 and 2022. So just, what's this one? This is 2022. So just copy off here rather than opening them up yourself, because that could be time consuming. So 2022 was 254. And 2023 was 295. Then for 2020, we'll just do this bit first where we percentage growth. You take the year divided by the previous year minus 1. Along. There we go. Then your average revenue per store is, you take your sales divided by the number of stores. For this, we actually want to see the decimal place though. There we go. Then for the licensing revenue, we take come back. Come back to here. $40.714, $45.047. So 15. Now the number of licensed stores for 2022, it was 30. Okay, we know it's bigger, 182. For 2023, it was 223. For 2024, 646. $250. So yeah, 44 plus 206 equals 250. So the average revenue, remember these are franchises, so the licensing revenue is just a fee they collect, so it's significantly less than the company operated stores. So from the international restaurants, they're making about 180K a year in their licensing fees. So, oh, I forgot to add the. Okay, so let's go on to 2025. So for 2025, they added, there's 359. So for the first 9 months of 2020, so yeah, for 2025, the first 9 months, they have 359 restaurants, and they added 13 in that previous quarter. So let's say they have 372. And for the licensed stores, they were operating 271 in the first 9 months, and they'd added 7. So let's call that 278. What we need to do now is come onto the revenue. So to work out for to forecast for the last quarter in 2025, we're going to divide the full figure for 2024 divided by the first 9 months, first 39 weeks of 2024. That will give us a multiplier that we can use, attach the same one for 2025. 0.35 equals 1005.908 times 1.53953. So revenue per store hasn't really increased, will probably not really increase this year, but the store count is increasing, so overall revenue will. For the licensing, if you take 45 divided by 32.995, 1.365, let's take 38.867 multiplied by 1.36526746. Okay, now let's start simulating or building a way to simulate bullish, bearish, and base case scenarios. So for number of stores, we need, and we're going to use this. This multiplied by this will give us our forecasted revenue. It means that we can play about with the number of stores and average revenue per store. So if we say we should anticipate that this will get to about maybe 700 stores. So let's go 15% here equals G15. Sorry, G11. So to work out, we'll put this one actually going at 3%. So to work out what these cells will be, what we do is going to do some formatting. Is we go equals, we take the previous year, subtract, open brackets, the previous year minus the final year, divided by the final year minus the previous year that we're looking at. Because we're just going to copy and paste this so that it adjusts dynamically, we need to lock a few things in. For this one, we want to keep the column the same, but not the row. For this one, the cell, this one always stays the same, so we lock both in. Then for here, we lock in the row, but not the column. Whoa, no, I've done something wrong. Always use your brackets. And we'll say the bear case will be 95% of this base case. So the bear is, you take the base, multiply it by your bear case scenario. Pull that along. We do the same for the bull. Then to simulate between all of these, what we want to use is a function called offset. So we go equals offset, the cell that we're in, G31, the switch that we're using, in this case, C11, make sure to lock it in because it will always be the same for the whole row. Then comma, then 0, put it along. Then for the future, to forecast the number of stores, you take the previous year multiplied by 1 plus the store growth rate. Pull that along. We're just going to take this, copy it down here. Change this to 12. I'll fix it in a second. There we go. Bring the offset function down as well. We are anticipating same store for the average revenue per store to grow at about from about $3.7 million per store up to I guess 4.2-ish. So overall sales we will now put as equals number of stores multiplied by average revenue per store. There we have it. Maybe 15 is a bit aggressive. Let's keep it at 13. Yeah, okay. We're going to do the same with the franchises now. And we'll say that, let's say it goes to 10%. Again, we can just take our offset function. So for those of you who haven't seen how the offset function works, basically what we do is we simulate different growth rates using the bare, base, and bull case scenarios. We leave the switch on 2, that's the base case. But if we switch to 1, remember these figures here? See, they come down. Come back up to base, they go up. And then they go up if we go bullish. So yeah, that's what that function does. And it allows us to simulate different scenarios, which gives us a different share price at the end. Let's do the same now for average revenue per store. If we say, let's say 5% growth. Just make sure to put everything. So for me, when I've copied it, I need to make sure it's on the right switch. So I'm changing this from 15 to 16 so that it corresponds with the right one up here. Okay. Now, to work out the licensing revenue, we take the number of licensed stores, multiply it by the average revenue per store. Pull that along. This is quite a big jump to go from 278, that would be 42 stores that opened up. They did 28 last year. I think this is maybe a bit, they have the potential for growth, but I don't think it will go that fast. So let's just do the last 2 years. Yeah, I think that's a bit better. Okay, so that's it. We forecasted the revenue for the next 5 years. Now let's sum up what our total revenue is going to be. Equals sum, licensing revenue, and SHAK sales. 742. Yeah, that looks good. Bold it. So we're saying in the next 5 years, it's going to double its revenue. Yeah, I mean, I think it's feasible. When you think about, say, Chipotle has, how many stores does it have? You know, it's in the thousands, like 3,000. So Shake Shack has maybe 630 currently. So yeah, so it's I don't think we're being too I think we're being realistic there. Income statement is the next section. First one, as always, is revenue and wage growth. Let's put this equal to what we've calculated. And the next line is the EBIT. You want to know what this is as a percentage of revenue. So the EBIT, we come onto 2024, this one. We come back onto the income statement, which is on the 10K, they usually put them at the very end of the report. So here, minus 26.894. Then 5.921, 3.038. Hopefully this will be significantly higher. So this is good. This should do about 43 million in EBIT, but it was negative last year, then it swung to profit. So this doesn't give us a very good way to calculate it. So let's do this. 43764 times, we'll do 1 times 1.3. And that should give us a rough guide for what the EBIT should be. And when the next 10K comes out, we can update this properly. Okay, this EBIT is just a placeholder. We do the proper one in the DCF section. So taxes in down here, I got it wrong, minus 1.180 minus 4.010, 3.424. Let's just do this. 14.366 multiplied by 1.3233. A very high tax rate. No, I think let's just go with 14.366. Leave it at about 25%. Sensible. And we'll have that going forward. Okay. The next section is going to be the cash flow items. And these are the depreciation and amortization, the capex, and the change in net working capital. We find these on the cash flow statement, which is here. So in 2022, depreciation and amortization was 72.796. Then it was 91.242, 102.468. This is percentage of revenue. CapEx is this one down here, purchases of property and equipment, 142.559, 146.167, 135.499. Again, we work out what this percentage of revenue. Change in net working capital, we just found this line here. So equals sum 9.139 negative 0.334 negative 2.473 negative 8.065 3.541 3.502 2.859 8.541 negative 61.364 negative 0.756. Next one, again, we go equal sum, negative 2.970, negative 1.220, negative 2.253, negative 6.307, 0.687, 9.513, 3.328, negative 2.809, negative 58.216, 2.292. Same again, equals sum, negative 2.839, negative 0.610, negative 0.629, 6, 3.356, 6.644, 4.477, negative 0.712, negative 77.167, 2.939. There we go. Onto the 10Q. Come back to the top because they put the financial statements at the beginning on the 10Q rather than at the back like they do on the 10K, the page we want. So if we take the 2024 amount and divide it by the first 3 quarters of the year, for 2024, we get a multiplier of 1.337 equals 80.67 multiplied by 1.7. This thing about 8% per year, we just take that percentage and multiply it by the revenue to find out what forecast what we think it's going to be going forward. CapEx down here. So 135 divided by 100.801, 1.34. So you take 106.697 multiplied by 1.3442278. Okay, the same with a change in net working capital. We'll just leave it as it is and we'll just do that sum here because it's a bit too hard to forecast otherwise. Okay, now those are the cash flow items. They're a bit lengthy because the change in net working capital was there were so many line items. Let's go into the next section is the DCF. First line is always revenue, but it equal to what we have for this one. Okay, the next is the EBIT. I'm just going to copy one of these down. Let's just copy this. The EBIT equal to what we have forecasted, but keep the if we say EBIT will eventually get back or get up to, it's not going to stay, I don't think it stays this low. I think let's say the EBIT margin gets to 18. So we're saying that there will be quite a bit of margin expansion. Yeah, I think that looks good. Let's make sure, yeah, we're on the right. Yeah. Change this one to the correct switch. Then EBIT needs to be your revenue multiplied by EBIT margin. This should be percentage of. Okay, yeah, that looks good. The next line are the taxes. And also I'm going to say that, let's say just goes down to 20%. Because 24 is quite high, I think. Percentage of it. Taxes, we just go equal. And going forward, let's just put 20%. Take your EBIT multiplied by your tax rate. There we have it. Okay, now we're going to calculate something called the EBR, which is your earnings before interest, but after tax. This is, it's simply you take your EBIT, you subtract your taxes, there we have it. Now we need to bring in our cash flow items. So this line should be unlevered free cash flow. The way we calculate it is we go equals, you take your EBR, you add back in depreciation and amortization, you subtract your capex, and you subtract your change in net working capital. Now that's it, we have our unlevered free cash flow. We want to find the present value of unlevered free cash flow. So what we need to do is we need to build something called the WACC, the weighted average cost of capital. So come on to another sheet and we go, obviously take off your grid lines first, make your A smaller, but you don't have to freeze the column. So the WACC is the weighted average cost of capital, which is the percentage of equity multiplied by your cost of equity plus your percentage of debt multiplied by your cost of debt multiplied by 1 minus your tax rate. And what we need for this is we need the market cap, the percentage of equity, cost of equity, which consists of the risk-free rate, your beta, your equity risk premium. Don't worry, I'm going to show you how to calculate all of these in a second. Then you want your debt, your percentage of debt, cost of debt, tax rate, put a total line here, and then WACC. Sorry. Whoa. Come on. WACC. Okay, market cap. We don't have that at the moment. Well, let's see if it's working now. No, okay, it's not working. So we'll just take what it says on the share price where we're looking at the graph. Market cap 3.563 billion, which we put as 3563. Because remember, we're doing this in billions. We don't know the percentage of equity yet. We don't know the cost of equity. We'll do this all in one go, but we know the risk-free rate, but we'll come back to it in a second. Let's go to the debt first. Onto the balance sheet on the 10Q, because that's the most recent information that we have. So the total debt, does it have any short-term debt? No. And what we want by debt, we mean interest-bearing debt, so long-term debt. 247,469. 247.469, meaning now our total is the debt plus the equity. So our percentage of equity is our market cap divided by the total. So this is a majority equity company. We do the same with the debt. And the cost of debt, the way we'll find this is we take the interest expense. So for here, equals 1.615 divided by 3 multiplied by 4 to get an annual amount. So we will go now equals 2.15333 divided by 247. So it's only a 1% cost of debt. Yeah, okay, possibly. And the tax rate, see if they've got it somewhere. It will be down income taxes, effective income taxes, 28.1%. Okay, now the risk-free rate is simply, it's the US 10-year. The US 10-year Treasury, 4.195%. The beta, we can find this on, give me 1 second. Okay, so what we want to do is we want to find we don't need, it's only going to be one industry, Shake Shack. It will be restaurant and dining, 0.81, the average unlevered beta. Where is it? Yeah, 0.81, that's what we're going to use. But for the equity risk premium, let's see if there's a breakdown of where Shake Shack, well, we know where it does because we have all of those of their restaurants, but we'll... It doesn't put where it generates. We're looking for something that says for revenue, US, and then international. We'll find it in a second. No. Okay, well, I mean, what we will do is, okay, region, we go US, international, revenues, weight. Let's go ERP, weighted ERP. So we know that there was a breakdown of stores at one point. Where did I see that? It's somewhere here. What we need is okay, revenues for the US are going to be this line. Then for international, we'll just put the licensing revenue, and we'll multiply it by... So if they have, how many stores do they have? 278. About 50 of those are US, are US licensed. So the international ones are going to be, let's do 278 minus 50. That is 228. Then we go times 228 divided by 278. And that should give us our international revenue. And for this, let's do this again. We'll go plus 9.5. Okay, yeah, that's about right. We know the US is 4.61% for the ERP, the equity risk premium, which I'll pull this up for you. Okay, so you can get this spreadsheet on Professor Damodaran's website. I would recommend you do. He'll be releasing his New Year one shortly, so make sure you download that when it comes. So for the US, 4.61%. Global is 5.88. Let's take out the US, and we get 6.41%. So those are our ERPs. The weight is you just take the revenue divided by the total. Now the weighted ERP, you just take the ERP multiplied by the weight. Then you just sum them together, 4.67%. Okay, your cost of equity equals your risk risk-free rate plus your beta multiplied by your equity risk premium. So that's what we'll calculate now. Risk-free rate plus your beta multiplied by your equity risk premium. Oh, no. That's going to happen. I forgot to... So 7.97% for the cost of equity. So our WACC is going to be the percentage of equity multiplied by the cost of equity these in brackets so they don't get messed up, plus the percentage of debt multiplied by the cost of debt multiplied by 1. I'm sorry, not working. So equals, open brackets, the percentage of equity multiplied by the cost of equity plus the percentage of debt multiplied by the cost of debt multiplied by 1 minus the tax rate. .5% WACC. Okay, come back onto the other sheet now. The WACC could equal to so for the bear, we take the WACC and we add on 0.5% because a higher WACC is bearish. For the bull case, we take the WACC and we subtract 0.5% because a lower WACC is more bullish. The terminal growth value we're going to say is 3%. The bearish will be minus 0.5%. The bullish will be plus 0.5%. Make sure that this figure is never more than GDP growth. So now we're going to use the offset function, but a different version of it called choose, and just select each of these in the correct order. Do the same for the terminal growth value. Just copy this down, and it will adjust it automatically for us. So come back to our present value of free cash flow. To work out the present value of the unlevered free cash flow, you just go equal, you take your unlevered free cash flow divided by 1 plus your WACC, close brackets, to the power, lock the WACC in, and okay, above these, we just need to put, I forgot to put these in, but go 0.5, and do it up to 4.5, because we're using a mid-year convention. We're saying that SHAK doesn't generate all its revenues at the end of the year, it's throughout the year, or sorry, it generates its cash flows throughout the year rather than just at the end of the year. So we take the midpoint as where to discount back from. And just put this to the power of that year, then pull it across, and there we have it. That's our present value of unlevered free cash flow. We then calculate the terminal value. To do this, you take the unlevered free cash flow multiplied by 1 plus your terminal growth value, those brackets, divided by your WACC minus your terminal growth value. Also double bracket here if you want to just make sure. Now to get the present value of your terminal value, again, you just take your terminal value divided by 1 plus your WACC to the power of that final year. We have it. The next calculation is the enterprise value. All this is you go equal sum, you take the present value of the terminal value, comma, and all of the present value of unlevered free cash flows that we forecasted. This then goes on to us calculating the equity value. And that is we add the cash back in and we subtract the debt. So 357.757. And the debt, we know that because we've calculated it over here. So you take your enterprise value, add the cash, subtract the equity value, subtract the debt. And this gives us the equity value. Then we take the diluted shares outstanding, which is here, 41.852. The good thing is this is decreasing. The share count is decreasing, which is bullish. And then you take your equity value divided by your diluted shares outstanding, and there we have it. A target price of 134 equals K21 21. Work out the upside or downside, we take the implied divided by the difference, subtract 1. So potentially a 60% upside. In the bear case, we'd be looking at about 102 for the target price on the bear. If everything goes to plan, then 185 on the upside. So yeah, that's quite interesting. It's one to follow. Obviously, this is not financial advice, but do your own research and tell me what you think of the SHAK. Okay, yeah, I think that's it for today, and I'll see you on the next video. Thank you very much for watching, and have a good rest of the day. Thanks. Bye.